does take us to our talk of the tape. Where are these markets heading next? Let's ask Adam Parker. He's the founder and CEO of Trivariate Research, a CNBC contributor, and he's with me at Post 9. Welcome back.
Thanks for having me.
The thing that jumped out to me most of all from the notes you gave our producers are the fact we were more cautious on risk-taking last week than we are now. Why?
Well, that's really consistent with what you just heard from Tepper on the previous minute, which is I think the stimulus means something. You know, we look back at 11 times China stimulated in the last 13 years. Mm-hmm. It's hard to say it works every time because sometimes we're hiking rates here and other things are happening. But when you look at the market, there's a group of stocks that have somewhat low expectations, are kind of hated, and they trade like the A shares. A lot of them are in energy, materials, industrials, et cetera. So I think if you're a portfolio manager and you're trying to beat the S&P 500, you reacted to that news on the 24th, and you said, all right, I could maybe buy a casino, or I could buy a copper company, or maybe what they did yet isn't enough to make the earnings change. But the risk reward just got skewed to the positive with companies that have exposure there, and that's how I think about it.
Do you think that the risk reward is now better overall here in part because of this? It just underscores the fact that central banks, governments around the world are flooding the zone with liquidity again.
Yeah, when I thought it was
cutting rates,
when I thought it was just cutting the rates alone, I was like not sure, as we talked about, when it's going to be fiscal stimulus and cutting rates. Now you're building, more of a story. I mean, at the beginning of the year, I went back to my year-ahead outlook on January 1st. What did it say? I'm bullish, but I'll get negative if the consumer slows, China gets worse, or financial conditions tighten. We go into July, I say, you know what, I'm a little bit more 50-50 now. I'm not as bullish because the consumer's slowing.
No, you've been a little more cautious
consumer slowing
for the last couple of months.
Yeah, more about the consumer slowing, right? But now you say, okay, well, China's not getting worse, maybe it's getting better, and the very recent data points the consumer isn't declining at a more rapid rate, right? I think it's sort of, depending on your interpretation of jobs on Friday, I think it's a big number. There's some stuff coming. But yeah.
It just reminds us that almost every single moment over the past 18 months where people have said, if this happens, or this could happen, or that could happen, it hasn't happened. Yeah. The market's been crazy resilient. Yeah, one of the most resilient markets I think we've ever seen. Yeah. And others point to a lot of noise distilled down into the facts of a Fed that's cutting and just starting, and the economy that is still surprising people with its resilience.
Look, the 2- and 10-year yield are 100 bips lower at the end of Q3 than they were at the end of Q2, right? The Fed, I think, surprised. Nobody thought there was 50 bips, or very few people thought it was 50 bips on July 1. Consumer slowed, and yet the market kind of had a healthy 5% plus, almost 6% total return for the S&P in the quarter, right? So I think things are slightly skewed to the positive. I'm a little worried about earnings season. Not so much the Q3 numbers, because we didn't really hear any of the big conferences corporates tell us. We've had some Nike and some FedEx and some things that are happening.
Nike's idiosyncratic.
Nike is definitely, FedEx maybe. They're, I would say, a real company, $90 billion in revenue. They ship some stuff around. So we'll see if we get any pre-negs in the next 5 or 6 days. Normally that first 10 days of a October, or January, April, July, you could see a company take the. I don't think it's going to happen that much. I think it's more going to be the Q4 guidance.